Let me start with something that sounds ordinary, but really isn't. Two countries reduce silver production, and suddenly the global market feels uneasy. Not panicked yet, not screaming, just uneasy. That discomfort is important because markets don't break when everyone is shouting. They break when no one is paying attention. At first, the news comes in quietly. Mines in Peru face disruptions. Operations in Mexico slow down. Some closures are called temporary. Some are blamed on labor issues, some on regulation. Nothing that sounds catastrophic on its own. Most people scroll past it. Even traders glance and move on. Because in isolation, mine shutdowns happen all the time. But silver is not a market that survives on isolation. It survives on balance. And that balance is thinner than most people realize. Silver is pulled in two directions at the same time. It behaves like a precious metal, a store of value, a hedge against uncertainty. But it also behaves like an industrial input, quietly embedded inside solar panels, electronics, medical equipment, electric vehicles, and infrastructure the modern world cannot function without. That dual role is not a strength during stress. It is a vulnerability. Here's the detail that changes everything. Most silver is not mined because someone wants silver. It is mined as a byproduct of other metals. That means silver supply is not responsive. Prices can rise, demand can surge, headlines can explode, and still, supply does not immediately increase. Mines cannot turn on silver production like a tap. So when major producing regions slow down together, the system does not adjust smoothly. It tightens. At first, the tightening is invisible. Futures markets still trade, charts still move, analysts still publish forecasts. On the surface, nothing appears broken. But behind the scenes, physical buyers begin asking different questions. Not about price, but about timing, about delivery, about reliability. When will the metal arrive? Can it arrive? What happens if it doesn't? Those questions change behavior faster than price ever could. Industrial buyers cannot afford uncertainty. A solar manufacturer missing silver is not missing profit. It is missing production. Medical suppliers cannot wait for markets to stabilize. Defense and infrastructure projects do not pause because commodities are volatile. So instead of waiting, buyers start securing extra supply. Not because they want to speculate, but because they want certainty. This is the moment where supply crises actually begin, not with panic buying, but with quiet hoarding. Silver that once flowed freely through the system begins to slow down. Refiners hold more inventory. Fabricators delay selling excess. Bullion banks become cautious with physical commitments. Each decision is rational on its own. Together, they choke circulation. And here's the most dangerous part. The paper market continues to function normally. Contracts trade. Liquidity looks healthy. Prices look contained. But paper silver can multiply infinitely. Physical silver cannot. When those two realities drift apart, stress builds silently. This is not fear-driven behavior. It is logic-driven behavior. People are not reacting to headlines. They are reacting to fragility. What started as mine disruptions in Peru and Mexico now touches something much larger. It touches trust. Trust that silver will be there when needed. Trust that delivery will happen on time. Trust that the system has margin. And once trust starts eroding, it does not wait for confirmation. That is why the story matters before prices explode. Because by the time silver starts making noise everywhere, the real shift has already happened quietly. This is the opening phase of a supply crisis, and it never feels dramatic while it's starting. After the first shock of mine shutdowns in Peru and Mexico, the silver market does something that often confuses people who only watch prices. It goes quiet. Headlines slow down, charts stop exploding, and many assume the danger has passed. But in financial systems, silence after disruption is usually not recovery. It is digestion. The market is absorbing damage, not healing from it. This is the phase where behavior changes before numbers do. Large industrial buyers stop thinking in terms of quarterly costs and start thinking in terms of survival. Silver is no longer treated as just another raw material. It becomes a risk item. Procurement teams revise strategies, inventory targets increase, safety stock becomes non-negotiable. Contracts that once relied on trust are rewritten with strict delivery terms. Every one of these decisions quietly removes silver from circulation. Nothing dramatic happens on screen, but the system tightens. The same ounce of silver that used to move freely from miner to refiner to manufacturer now pauses longer at every step. Everyone wants control. No one wants exposure. This is how shortages deepen without showing up immediately in official data. At the same time, the paper-silver market keeps functioning as if nothing fundamental has changed. Futures contracts trade smoothly. Liquidity appears healthy. But this is an illusion created by abstraction. Paper silver can expand infinitely. Physical silver cannot. When supply disruptions continue, the gap between these two realities widens. And the wider that gap grows, the more fragile the system becomes. Industrial demand does not wait for confirmation. Solar manufacturers cannot delay production because mines are offline. Medical suppliers cannot pause orders because delivery risk has increased. Defense and infrastructure projects are locked in politically and financially. That means demand remains steady, even as supply becomes uncertain. In economic terms, this is inelastic demand meeting constrained supply. That combination does not resolve gently. Meanwhile, investors who normally ignore silver begin paying attention. Not because of hype, but because stress leaves fingerprints. Physical premiums rise quietly. Delivery timelines stretch. Inventory reports start drawing scrutiny. These are not emotional signals. They are operational ones, and professionals understand them immediately. This is also when volatility begins to creep back in. Not explosive volatility, but nervous volatility. Small price moves trigger outsized reactions. Dips are bought faster. Sell-offs feel weaker than expected. This tells you something important. Ownership is shifting. Silver is moving from traders who chase momentum to holders who value certainty. That shift matters more than price levels. Holders do not sell easily. They do not react to daily news. They wait. And when silver reaches holders, available supply shrinks further, even if production numbers remain unchanged. What started as mine shutdowns in Peru and Mexico now shows its real impact. The market is no longer asking when supply will return. It is asking what happens if disruption becomes normal. Once that question enters pricing models, the old market is already gone. This is the most dangerous stage of any supply crisis. Not the panic phase, the adjustment phase, because by the time panic arrives, positioning is already complete. After the initial tightening begins, the silver market enters a phase that confuses most observers. Prices may not explode immediately. In fact, they may even pull back slightly. And this is where many people make the mistake of assuming the danger has passed. But markets do not resolve supply stress through instant drama. They resolve it through slow behavioral change, and behavior is already shifting. Large industrial buyers quietly change how they operate. Silver is no longer treated as a routine input that can be reordered anytime. It becomes a risk item. Procurement teams begin revising contracts. Delivery guarantees become more important than price discounts. Inventory buffers grow. Companies that once optimized for efficiency now optimize for security. None of this makes headlines, but all of it removes silver from active circulation. At the same time, refiners and middlemen adjust their posture. Selling forward becomes uncomfortable when replacement supply is uncertain. Holding inventory feels safer than committing it, so silver starts sitting still for longer periods. It is not consumed faster, but it is released slower. That alone tightens the market more than any speculative buying ever could. The paper market, meanwhile, keeps doing what it always does. Futures contracts roll over smoothly. Trading volume remains high. On screens, everything looks normal, but this normality is misleading. Paper markets are built on confidence that physical settlement is possible if required. When mine disruptions in key producing regions persist, the confidence weakens quietly. This is when physical premiums begin to rise without much attention. Not dramatically, but persistently. Delivery times stretch, availability becomes inconsistent. Buyers who actually need silver notice immediately. Those who only watch charts do not. And then something subtle happens. Investors who normally ignore silver begin watching it differently. Not as a trade, but as an indicator. Silver starts behaving like a stress signal for supply chains, inflation, and industrial fragility. Even modest interest from capital markets feels large because the silver market is small relative to global money flows. As prices lift, volatility increases, but it is not chaotic volatility. It is tense volatility. Moves feel sharp but controlled. Pullbacks are shallow. Buyers appear faster than expected. This tells you ownership is changing. Silver is moving from short-term traders to long-term holders, from people who chase price to people who fear absence. That shift matters more than any price level. Holders do not sell easily. They do not respond to daily news. They wait, and waiting reduces supply further. What began as a production issue now becomes a structural question. Not when will mines reopen, but what if this happens again? Because once a system shows vulnerability, it becomes fragile in the mind of every participant. Markets price memory as much as reality. This is where the silver market starts losing its old identity. It stops behaving like a predictable industrial metal. It starts behaving like a scarce strategic resource. By the time the market reaches this stage, the original trigger almost feels irrelevant. Peru and Mexico are no longer just countries with mine issues. They are symbols of concentration risk. The realization sinks in that global silver supply depends heavily on a few regions, and that dependency was never priced properly. Now silver's dual role becomes dangerous. Industrial demand continues because it must. Solar installations do not pause. Medical production does not slow. Infrastructure commitments do not reverse. At the same time, monetary demand grows as investors look for assets that sit outside debt-heavy financial systems. Two different motivations collide, chasing the same limited metal. This is when the market does something counterintuitive. Higher prices do not immediately increase supply. They reduce it. Holders delay selling. Recyclers wait for better levels. Producers hedge cautiously. Everyone senses that letting go now might mean not being able to buy back later, so silver stays locked up. Traditional analysis starts failing here. Models based on elasticity stop working. Commentators talk about speculation, but speculation alone cannot explain persistent tightness. The problem is not excitement, it is constraint. Volatility rises again, but this time it feels different. Price moves feel heavier, corrections are shorter. The market stops offering comfort. This frustrates short-term players and rewards patience. Over time, this hardens the market further. Behind the scenes, long-term contracts are rewritten, penalties increase, optionality disappears, guaranteed supply becomes more expensive. These changes quietly raise the baseline cost of silver across industries. Once these costs are accepted, they do not roll back easily. At this point, silver is no longer repricing just ounces, it is repricing trust. Trust in supply chains, trust in delivery, trust in the idea that the metal will always be there when needed. And once that trust is questioned, the market does not return to its old state. It moves forward. By the time the silver market reaches this final stage, something important has already happened. The market has stopped arguing with reality. There is no longer a debate about whether supply disruptions matter. There is only the question of how the system adapts to a world where supply can no longer be assumed. This is the phase where price stops being emotional and starts being functional. Silver is no longer moving because traders feel excited or afraid. It is moving because the system needs it to move. Higher prices are not a signal of excess. They are a tool used to ration access, to slow non-essential demand, and to force difficult decisions across industries that once treated silver as abundant. At this point, the market no longer reacts strongly to reassurance. Statements about production, restarting, or disruptions easing sound good, but they do not restore confidence fully. Because confidence, once damaged, demands proof over time, not promises. Participants have learned that supply chains can break quietly, and that lesson stays embedded. Now behavior locks in. Corporations change how they plan years ahead. Silver procurement is no longer optimized only for cost. It is optimized for certainty. Long-term supply agreements replace spot buying. Inventory buffers become permanent instead of temporary. Financial planning assumes higher baseline prices rather than hoping for mean reversion. These decisions do not reverse easily, because reversing them would mean trusting a system that already failed once. Governments, even if they never say it publicly, begin reassessing dependencies. Silver is not a headline commodity, but it sits inside strategic priorities. Energy transition targets depend on it. Medical resilience depends on it. Technological independence depends on it. When a metal quietly touches so many national goals, uninterrupted access becomes a security issue, not just a market issue. This is why silver behaves differently from most commodities in crises. There are no emergency press conferences about silver. There are no visible price controls. The market is allowed to adjust freely. And because it is allowed to adjust freely, it adjusts brutally, honestly. Prices rise not because someone wants them to, but because something must give. As prices climb into ranges that once felt unrealistic, resistance fades. Levels that used to feel extreme begin to feel justified. Anchors shift. The market stops asking how high silver can go and starts asking how tight supply really is. That change in question marks the psychological completion of the crisis. At the same time, new supply still cannot arrive fast enough to relieve pressure. Projects delayed for years cannot be accelerated meaningfully. Environmental approvals remain slow. Labor constraints persist. Recycling increases, but only at the margins. The system responds, but it responds sluggishly. And in commodity markets, slow response means sustained repricing. Eventually, balance is restored, but not by returning to the old world. It is restored at a higher level of price, higher level of caution, and lower tolerance for disruption. The silver market that emerges after this phase is tighter, more defensive, and less forgiving than the one that existed before. What makes this moment historically important is not just where prices settle, it is what the market remembers. Investors remember fragility, industries remember delays, policymakers remember vulnerability, and memory shapes future behavior more powerfully than charts. Years later, people will look back and try to pinpoint the moment silver changed. They will search for a single headline or a single spike, but the truth will be quieter than that. The change began when supply disruptions revealed how little margin existed, when two key producing regions slowed and the entire system felt it. That is how real supply crises work. They do not announce themselves loudly at the beginning. They reveal themselves slowly, through behavior, through hesitation, through tightening that no model fully captures. And by the time everyone agrees that a crisis occurred, the market has already adapted to a new reality. This is not silver reacting. This is silver recalibrating its role in the modern world. And once that recalibration happens, there is no rewind button. And now, when everything settles into place, this is the part most people misunderstand. They think the story ends when prices stabilize. They think the crisis ends when production resumes. But in real markets, the most important phase is not the beginning and not even the peak. It is what comes after. Because after a supply crisis, the world does not return to normal. It adjusts to memory. By this stage, the silver market has already absorbed its lesson. It has learned that global supply is concentrated, fragile, and slower to respond than demand. That knowledge alone permanently changes behavior. Even if mines in Peru and Mexico fully reopen tomorrow, even if output normalizes on paper, the market will not forget how close the system came to strain. Industries will not go back to running lean. Investors will not go back to assuming abundance. Contracts will not go back to casual delivery assumptions. Risk premiums stay embedded, quietly, invisibly, but persistently. This is why prices often remain elevated long after the original problem fades from headlines. Not because the shortage continues, but because trust does not instantly regenerate. Trust rebuilds slowly, ounce by ounce, year by year. Silver now exists in a different psychological category. It is no longer just something you buy because it is cheap. It is something you secure because you cannot afford to be without it. That shift sounds subtle, but it is massive. It transforms silver from a reactive asset into a defensive one. And defensive assets behave differently. They do not collapse easily. They do not overshoot downward. They do not give comfort to late doubters. Instead, they grind higher, reset expectations, and force adaptation. For the broader economy, this means higher embedded costs. For energy systems, higher infrastructure expenses. For technology, tighter margins. For governments, uncomfortable dependency questions. None of this happens overnight, and none of it makes dramatic headlines, but it reshapes planning decisions for years. This is why silver crises rarely look dramatic in real time. They look technical, boring, gradual. Until suddenly, years later, people ask why everything costs more and why certain systems feel tighter than before. And the answer traces back to moments like this, moments when supply revealed fragility, when markets realized there was no buffer, when assumptions quietly broke. So if you are watching silver now, understand this clearly. You're not watching a temporary spike. You are watching a recalibration, a slow structural adjustment that does not reverse just because charts pause. The loud part of the story may already be over. The quiet consequences are just beginning. And history shows that when a market teaches itself a hard lesson, it never fully forgets it. That is the real end of this story. Not panic, not collapse, but memory.